Last time, we dove pretty deep into innovative solutions and support a larger player in aerospace. Today, though, we're shifting gears quite dramatically. We're looking at Coda Octopus Group. It's a much smaller company, a microcap actually, specializing in subsea technology and engineering services. They're in the industrial sort of aerospace and defense space too, but with a market cap around $92-93 million.
Yeah, tiny compared to last week. And, this one is fascinating because the signals are just all over the place. You've got this frankly beautiful balance sheet, really strong, and some recent operational numbers that just pop off the page. Looks like massive growth kicking in. But then you look back a bit further and the historical returns are, not good, negative, in fact. And there's some insider activity lately that gives you pause.
Right. That's the core tension in it. How do you weigh those things? Is Coda Octopus Group's operational quality and this recent momentum, is that the real story now? A genuine growth opportunity? Or are those weak historicals and the insider selling telling us, hey, be careful, this valuation might be stretched? So that's the debate. I'm going to argue that the current numbers, the technology, the recent wins, they justify seeing this as a company hitting its stride with real growth potential ahead.
And I'll be taking the more cautious stance. I think that historical volatility can't just be ignored, and the signals from, people inside the company suggest there's significant risk here. I'm just not convinced this recent surge is sustainable, and at the current price, around $8.23, it feels potentially overvalued until proven otherwise.
Okay. Well, let me lay out the bull case then. It really comes down to two things for me. The exceptional financial quality and this very clear recent acceleration in their operations. First, that balance sheet. I mean, it's practically a fortress. Liquidity is off the charts. You're looking at a current ratio of 11.37. Quick ratio still incredibly high at 8.08.
Right, very liquid.
Very liquid. And debt, forget about it. Debt to equity is 0.01. It's basically zero. That's not just safe, it's a strategic advantage. They've got $2.33 in cash per share just sitting there. And this isn't just a pile of cash. It's built on real business. Gross margin is almost 61%, profit margin solid at over 14%. That's quality.
Sales growth up almost 30%, 29.34%. EPS growth, TTM, nearly 14%. And analysts looking forward, they see this continuing. They're projecting 38% EPS growth next year, up to 47 cents a share. This isn't just hope. It's tied to real things, like the acquisition of Precision Acoustics Limited, launching new tech, like the Echoscope Pipe NAGen series. It feels like a real turning point for a quality business.
See, I'm hesitant to call it a fully turned corner just yet. Those TTM numbers, yeah, they're impressive right now, but you can't just wave away the longer-term picture. We have to look at that 5-year track record. Over the last 5 years, Coda's EPS actually shrank by almost 8% per year on average. Sales went down too, over 4% annually. I mean, come on, a truly strong growth company doesn't typically post numbers like that historically. It speaks to the volatility, maybe the cyclicality inherent in their business. You can't just ignore that history.
That recent 29% TTM sales jump, I see that as pretty definitive proof that the market is finally adopting their specific proprietary tech. The past 5 years might have been laying groundwork, but now it's paying off. Think about the Francis Scott Key Bridge salvage work. Their subsea tech was reportedly the main survey tool used there. That's high profile. And we've seen actual contracts, like that $1.5 million order for their Diver Augment Vision Display System, the DAB system. That's advanced defense stuff. These aren't just random bumps. They feel like validation points for their core technology.
But are these sustainable trends, or are they, kind of lumpy wins? These specialized subsea and defense markets, they're known for being cyclical, right? Revenue often comes in these big, chunky contracts that can really spike your TTM figures temporarily. So yes, Q3 might have been great, but when a company's sales can swing from minus 4% over 5 years to plus 30% in the last year, that screams volatility to me. It suggests risk. What happens if the next big contract gets delayed or doesn't come through? Investors who piled in based only on that recent surge could get burned quickly. Is the market maybe discounting that 5-year negative growth too easily?
Look, even if we accept that growth might be somewhat lumpy, and in defense tech it often is. Let's talk about the foundation here, the balance sheet. That changes the whole risk profile. I have to come back to it. Current ratio over 11, basically zero debt. This isn't just about safety, it's about options. That pile of cash lets Coda Octopus Group fund its own R&D continuously, which is vital for a tech firm. And critically, it lets them do acquisitions like Precision Acoustics without taking on debt or issuing more stock. It gives them flexibility. And you see it in the beta, right? 0.53. That low beta reflects the stability this financial structure provides. It reduces the systematic risk for investors.
But safety has a price, doesn't it? The flip side of that fortress balance sheet is, well, it doesn't seem to be generating much return on the capital locked inside it. Holding $2.33 per share in cash, when your return on invested capital, your ROIC, is hovering around just under 6%, that to me suggests a potential issue with capital allocation. If management is sitting on all that cash but can't generate returns much higher than their cost of capital, well, that's not efficient, is it? It's conservative, maybe too conservative. It's risk-averse, yes, but it isn't really compounding wealth for shareholders very effectively. It makes you wonder, are there just not enough high-return opportunities for them, or is management struggling to actually deploy that war chest effectively?
But in a niche, defense-related microcap, maybe safety and strategic potential outweigh maximizing ROIC in the short term. Let's pivot, though. Let's talk about valuation and what investors are thinking, because I think the market is starting to see the potential here.
All right, investor sentiment. Let's definitely talk about that. Or maybe insider lack of sentiment? Because one thing that really stands out to me is the net insider selling, it's negative, about minus 1% recently. And specifically, you had Neil Sondergaard, who owns 10% of the company, selling a decent chunk of shares back in September. Now, why would a major owner, someone who presumably knows the tech and sees this supposed momentum, why would they be selling? Especially when the stock is trading, nearly 17% below its 52-week high? If this was truly a deeply undervalued growth story, wouldn't the insiders be holding on tight or even buying more? It raises questions, particularly when you look at PE ratio of around 27. Doesn't that feel a little rich if the people closest to the action are trimming their positions?
See, I think you're overstating the significance of that selling. Less than 1% net selling, when insiders still own almost 50% of the company overall. That 50% ownership is a massive alignment with shareholder interests. That minor trim could be for any number of personal reasons. It doesn't necessarily signal a lack of faith. Analysts are projecting that 38% EPS growth next year. Look at the analyst target price. It's $11. That suggests significant upside from here. So I'd argue the valuation is actually quite reasonable relative to the forecasted acceleration, not excessive.
Reasonable only if you buy into that 38% growth forecast completely, which, again, after a 5-year track record of minus 8%, well, that feels like a significant leap of faith. That's the risk right there.
Okay, so let me wrap up my view. Coda Octopus Group right now looks like a high-quality, profitable business in a specialized niche. They have proven proprietary technology. We see that in the recent strong TTM sales growth, the key project wins, and importantly, it's trading at what I see as a reasonable forward multiple, especially given that forecasted growth. Plus, that incredibly strong balance sheet acts as a significant safety net, reducing risk and giving them firepower for future strategic moves.
And my concluding thought is one of caution. Investors really need to balance that recent excitement against a history of, frankly, inconsistent performance. Those negative long-term growth rates, the relatively low returns on capital, despite the cash pile, these things matter. Until Coda proves this recent surge is truly sustainable quarter after quarter and shows they can deploy capital more effectively, the stock carries a real risk of volatility. And the fact that a key insider was selling even a small amount, well, it just adds to my skepticism about whether the current valuation fully reflects the underlying risks.